Hey everybody, it's Doug Shoemaker here, your go-to mortgage loan officer licensed in Illinois, Missouri, and Florida. And if you serve or have served in the military, I'm here to make sure that you get the best out of your VA benefits, especially when it comes to home loans. Now, today we're going to be diving into something that can save you a bunch of money and is actually my favorite mortgage loan. It's the VA interest rate reduction refinance loan, or VA IRRRL for short. Some people also refer to it as a VA Streamline Refinance. Now, this program can save you a bunch of money by lowering your interest rate on your VA loan with minimal effort. But before doing that, we're going to go over some pros and cons and whether or not this is actually the right move for you. So, what exactly is a VA IRRRL? Well, it's essentially a streamlined process to refinance your VA loan that allows you to drop the interest rate with minimal paperwork and hassle. Now, here's what actually makes it such a great option. First of all, there's no appraisal required. So this is going to save you probably $500 or $600 depending on the market you live in, because the property value isn't reevaluated on a VA interest rate reduction refinance loan. And this is going to save you both time and money. Now, the next thing is there's minimal documentation. You're only going to need to verify income, and the process can actually be completed a whole lot faster than most typical refinances. In terms of occupancy, where most loans require the property to be your primary residence to get the best possible rates, with a VA interest rate reduction refinance loan, even if you've turned your VA loan property into a second home or investment property, you can actually still refinance it and get those low rates. Now, the best part about the VA, Earl, is that it's easy. There's no need to jump through a bunch of hoops and paperwork, and you could potentially save thousands and thousands of dollars over the life of the loan. Now, here's some other key benefits. First of all, you're going to be able to lower your monthly payment by reducing the interest rate with minimal fees and, as I said, minimal paperwork. There's no occupancy requirements, as I stated earlier, so whether it's your primary residence, second home, or rental property, you can still qualify. There's no required out of pocket costs, so most fees can actually be rolled into your new loan balance, making it a whole lot easier to refinance without having to pay a bunch of money out of your pocket up front. But as great as all of this sounds, you do actually need to be aware of some of the potential downsides. I get a lot of calls from clients who get really convincing stuff in the mail promising to save them tons and tons of money on their monthly payments. And while some of these look really good on the surface, they may not make a whole lot of financial sense once you dig into the details. So here's a couple things that you need to consider. First of all, most lenders are going to be rolling the fees of your loan into your loan. So that causes a lot of people to not really look at those fees, but those fees actually increase your loan balance and could potentially reset your loan back to a 30-year term. Now, in some cases, you're going to have a VA funding fee, but if you had a funding fee when you purchased your home, you'll be glad to know that on the VA interest rate reduction loan, the fee is only 0.5%, where, they're much more expensive on purchase transactions, whether it's your first or subsequent use. Now, unless you have a disability compensation from the VA, you're going to have that fee. If you have any disability rating at all, they're going to waive that fee for you. Now, if your disability claim was applied for prior to your new loan, once you're actually approved, it's highly likely that you're going to get this refunded back to your loan. But it's something to keep in mind. If you don't have a disability rating, you will be paying that funding fee. Now, VA also has a 6-month waiting period from your first payment between refinances. So the right strategy is at least as important as the right rate when it comes to timing. Now, one of the most common questions I get is, am I going to actually save money with this? And the answer really depends on your unique situation. For example, if you're only lowering your interest rate by maybe 3% or 0.5%, the savings might not be enough to outweigh the cost of refinancing. Now, as I said before, many lenders are going to try to refinance you every time rates drop so they can get more paychecks. But if we expect rates to drop even further in a short period of time, say a month to 3 months, you might want to start watching the market really closely, or make sure that you're working with a certified mortgage advisor that's going to watch the market for you and help you not only with the right rate, but also the right strategy. So here's how to break it down in terms of comparing your current loan to the new loan. I want you to compare the total interest costs. So if you look at how much interest you'd pay on your existing loan, if you continue to make your monthly payments throughout the duration of the loan, and then you compare that to the refinance loan. Now, remember, on the refinance loan, you can't just look at the total of payments. You've got to look at the fees that you paid as well. because they are rolled in. One of the other things you got to look at is the fact that you're resetting the clock on your loan. And what I mean by this is, I'll just give you an example to help it make sense. Many years ago, my parents had built a house and their rate was about 7.75. About 15 years later, the market had changed and rates went down to 6%. I had just gotten in the mortgage industry back in those days. And every bank in the world was calling mom and dad, telling them that they needed to refinance. They were crazy because they were missing the opportunity to save a 1.75% reduction. Well, when you start your mortgage loan, the majority of the interest is paid in the beginning. So when you look at the amortization schedule they give you at the closing, the majority of that payment's going towards interest and a little tiny bit is going towards principal. But every payment you make on your loan, that starts to flip-flop. So for mom and dad, they'd reached their halfway point on their loan. The majority of their payment was going towards principal. They had paid almost all the interest on their loan. So for them to refinance at 6%, that meant the interest was going to completely start over, and that would not have made good sense for them. So that's something that you do want to be sure, as I said, that you're working with a certified mortgage advisor, or you know the market well enough to gauge that it's going to be the right time to do that refinance. So the next thing that we want to talk about here is that the VA has got a 36-month recoupment period. Now, I believe this is a really good thing. So the VA is going to require that the cost of your refinance gets recouped with the interest savings within a 3-year period. So let's say, for instance, you're saving less than $100 a month on your interest rate reduction loan, but the costs to do the loan are more than $3,600. Well, you're not paying your costs back within a 36-month period, and VA would not allow you to do that loan. I wouldn't either, because I don't think that would be a good loan for you. So we want to make sure that the costs are going to be recouped within a reasonable amount of time, especially when we're in a flat or a decreasing rate environment, because there's possibility that you may have additional refinance possibilities down the road. So the Shoemaker Loan Team uses the latest technology to compare your current loan to a new loan, and we're never going to twist your arm to do something that doesn't have a true financial benefit for you. Finally, I want to talk about a little bit of eligibility on the interest rate reduction loan. You'd be surprised at how flexible these things are. And for instance, you actually, when you do the interest rate reduction loan, you can add or remove a person from that loan. This could really be helpful if your personal situation has changed since you did your original loan. If you've gone through a divorce, you can actually still do the refinance even without the former spouse. Now, for veterans with disabilities, as I said earlier, if you've started receiving VA disability compensation after you bought your house, but before the VA interest rate reduction loan, you're going to get that fee waived. But let's say, for instance, you applied for your disability rating, but it hasn't been approved yet, but you applied prior to doing the new loan. Well, it could be 2, 3, 4, whatever number of years down the road. If you get approved for your disability rating, they're going to actually refund that funding fee back to your loan. Finally, here's a few things that make the Shoemaker Loan Team a little bit different. Now, we're actually members of something called the Home Foundation, which is a 501c3 that works to save our military and first responders money on everyday services like buying homes. We actually waive our origination charges, which saves you just under $2,000. Now, we use the latest software, as I said earlier, to deliver a personal, honest, educational approach to home buying. We also make a $250 donation to a local military 501c3 of your choice, and we do it on your behalf. Now, we're also going to introduce you to other service providers that are also part of the Home Foundation and are eager to help make your life better through discounts and above and beyond service. Now, I hope this breakdown of the VA interest rate reduction refinance loan, or IRRRL, has been helpful. If you're a veteran and you're looking to lower your mortgage rate, feel free to reach out. I'd be happy to walk you through the numbers and see if this option actually makes sense for you and your family. Now, if you're looking to purchase a home or sell, we work with some of the best real estate agents in the area. Many of these agents that we work with are military or first responders themselves, and they're going to be able to identify with your unique needs a lot better than most. As always, don't hesitate to drop a comment or give me a call if you have any other questions, or if you know anybody else looking to buy or refinance. Please don't keep us a secret. Thanks so much for watching, and don't forget to like and subscribe for more tips on maximizing your mortgage benefits.